Is Alibaba truly a value stock in the Munger mold? Should you follow him into the Chinese behemoth? Hey guys, welcome back to our channel. Today we'll be taking a look at what's behind Charlie Munger's big bet on Alibaba. First of all, show some support to our sharp team by subscribing or liking the video. Without further ado, let's dive into Munger's Baba mind. Countless investors closely follow Warren Buffett's every move, but many also keep an eye on his longtime partner and Berkshire Hathaway Vice Chairman Charlie Munger. Munger, who's 98, is still involved in the investment world, not only through his work at Berkshire Hathaway but also as chairman of the Daily Journal Corporation. Munger bought the Daily Journal for $2.5 million when he was still running his own investment fund decades ago. Munger distributed shares to his partners after his fund was dissolved, but he still owns about 3.6% of the company, which is now worth $455 million. The Daily Journal, which previously published a legal newspaper and has recently begun selling courthouse software, has an interesting feature in that it reinvests cash flow from its core businesses in equities, primarily large U.S. banks. Munger and company made headlines this week when the Daily Journal revealed a $37 million stake in Chinese e-commerce giant Alibaba Group Holding, accounting for 19% of the company's equity portfolio and ranking third behind Bank of America and Wells Fargo. Getting greedy. Munger has certainly earned his reputation as a brilliant investor. Furthermore, he shares Warren Buffett's illustrious reputation as a value investor. Charlie Munger comes from a league of investors, including his closest ally Warren Buffett, who never overlooks fundamentals before making any investment decisions, said Kunal Shani, CEO of equity research firm Kalkine. Alibaba, in which Munger's Daily Journal has more shares, has arguably the strongest fundamentals among Chinese companies. Indeed, when compared to many high-flying US tech names, a price-to-earnings ratio of only about 20 appears paltry. Despite a larger user base and a growing ecosystem, it is only worth a third of Amazon's valuation. As a result, Munger may be doubling down on the stock as it goes on sale, which is certainly consistent with his strategy. A more common expression is becoming greedy while others are fearful. Troubling trends. Nonetheless, there are numerous reasons to be concerned. For one thing, Munger's lack of fear in the first quarter appears to have been misplaced, as his margin of safety was not what he had assumed. As regulatory measures increased following the first quarter buy-in, the stock has steadily moved towards lower lows, following a relatively strong performance during the early stages of the COVID-19 pandemic. As Chinese consumers increased their reliance on e-commerce, a slew of risks quickly deflated its rally. This includes not only the disappearance of its famed founder Jack Ma, which is strange, at the end of 2020, but also the threats to the company's core. While the trouble arguably erupted most visibly in the run-up to Ant Financial's eagerly anticipated US IPO, regulators' pressure on Alibaba has not abated since. Indeed, under Xi Jinping's new Common Prosperity Initiative, major Chinese tech companies such as Alibaba, Pinduoduo, that's Duo, and Tencent, or TCEHY, have found themselves even more squarely in the crosshairs of regulators. In an apparent attempt to allay concerns about its soaring profits, Alibaba announced a $15.5 billion donation to government-led projects aimed at closing the wealth gap. To summarize, investing in a large e-commerce platform in a communist country is a risky bet. Prior to 2020, the promise was that China was not truly communist, or at least not so ideologically driven as to stifle its own growth. A crackdown on major tech companies like Alibaba continues. It appears that investors like Munger can no longer rely on the assumption that the government will simply allow businesses to thrive. However, things could get worse because Evergrande's slow-rolling real estate crisis has put the entire Chinese economy in jeopardy. For context, the real estate sector accounts for approximately 25% of China's GDP. Housing prices have risen to world-leading levels in recent years as the sector has gorged on debt. Consumer debt levels have also risen in a manner reminiscent of the 2008 housing bubble in the United States. Given the convergence of these concerns, the impact of the overall Chinese market could be significant, entrapping consumers. In this scenario, Alibaba's undervaluation would appear to be entirely appropriate. As a result, Munger may not be getting the deal he believes he is. But Alibaba may be even cheaper than that. Munger, like several other large technology conglomerates, may have looked at various parts of Alibaba's sprawling empire and realized these parts add up to much more than Alibaba's current market value. For starters, Alibaba has a significant amount of cash on its balance sheet, as well as large stakes in both private and publicly traded companies such as Ant Group. As of December 31st, 2021, its balance sheet included $47.8 billion in cash, $22.1 billion in short-term securities, and $36.8 billion in other publicly traded equity securities, and $28.4 billion in equity method investees like Ant Group. These assets total $135.1 billion, compared to approximately $18 billion in short and long-term debt. So while Alibaba's market cap is currently around $615 billion, when net assets are deducted, it's really only about $500 billion. That's a steal when compared to Alibaba's current operating income, which totaled $14.9 billion in the first 9 months of fiscal 2021, for a run rate of nearly $20 billion. Even so, Alibaba's true earning power may be underestimated by the operating income figures. This is due to the company's aggressive investment of large cash flows from its core e-commerce platform into other areas of its operations. Indeed, Alibaba is losing money in many of its higher growth businesses, including its local consumer services division, logistics arm Cainiao, Southeast Asian e-commerce firm Lazada Group, and cloud computing and digital entertainment divisions. These culminative losses reduce real operating income by about $5 billion over the last 9 months, despite the fact that these divisions likely have significant positive value. It all adds up to a bargain in Munger's eyes. Alibaba's core e-commerce operating income was nearly $20 billion for the 9 months ended in December, representing an annual run rate of about $26 billion. That's less than a 20 times EBIT multiple against $500 billion in enterprise value. And this is for a company that increased revenue by 37% last quarter. That appears to be a good deal. Alibaba's cloud computing division is one reason to be optimistic. Cloud revenue increased by 50% last quarter, and the division just reported its first quarter of positive adjusted EBITDA. Most people believe cloud computing is still in its early stages, particularly in China. So that division is likely to have significant value in the future, despite not contributing anything to overall company operating profits. Alibaba looks like a good deal if you can handle the China risk. Overall, Alibaba stock appears to be a great buy if investors can stomach the China risk. Notably, the SEC recently adopted a rule requiring US-listed Chinese companies to be audited by US tax authorities and to disclose Communist Party affiliations. As a result, some Chinese securities have fallen in value due to concerns about further US-China tensions. Munger, on the other hand, is a known proponent of China. He may believe that the headlines are scarier than the business reality. If that is true, he and the Daily Journal may have gotten a good deal on Alibaba stock. Aside from Munger's prodigious investment wisdom, the current Chinese economic difficulties, and the uncertain political environment ahead of the 2022 Party Congress, where Xi will seek a lifetime term, threaten to undermine otherwise viable valuation arguments. Furthermore, a shift towards common prosperity poses significant challenges to the consumer spending trend that have propelled Alibaba to its current position. We cannot allow the rich-poor divide to widen further, for the poor to become poorer while the rich become richer, Xi wrote in a recent essay. Echoing his increasingly socialist pronouncements of late, we cannot allow the wealth gap to become an insurmountable barrier. The problem for investors is that wealthy Chinese consumers drive a disproportionate amount of e-commerce spending, particularly on luxury brands found on Alibaba's Tmall online marketplace. In short, the sheer volume of questions surrounding Chinese stocks make determining a fair valuation for any of the headline names extremely difficult. As a result, in the case of Alibaba, it may be best to sit on the sidelines. With this, we've come to the end of this episode. What are your thoughts on it? Do let us know in the comment section below. Subscribe for more content just like this one and share it with your friends. And also, don't forget to hit that like button and also press the bell icon to get notified about our new videos. Till then,